Hello everyone, welcome back. Here is Ali Talabi and this is the second lesson from seventh module. So we started the module talking about the stock and the stock market. In this module, the major focus is on stock valuation. So in this lesson, I'm going to talk about stock valuation. That's our first part of the stock valuation. There are several techniques which I'm going to explain and explore with you, and we'll look at the different approach to find the value of the stock. So first, I will be clear in terms of the valuation. What do we mean by that? Intrinsic value versus market value. So I will mention and talk about those. And then I will talk about the return and the stock price and how the stock price and the return are kind of associated. And meanwhile, I will mention about dividend yield and the capital gains yield and how we distinguish between those two major concepts. And finally, in this lesson, I will talk about one of the major approaches, which is very common in the world of investment, which is using comparables. So I will show you how to use comparables and ratios to find the stock price. So let's start our session. So in the world of investment, there are two major approaches toward the security analysis. And more specifically, when it comes to stock analysis, either we talk about the fundamental approach or technical approach. In most of university lectures, in most of academic approach, where the major focus is on fundamental analysis. In fundamental analysis, the goal here is to find the intrinsic value of the security. And when I'm saying the intrinsic value, it means what is the true value or the economic value of a specific stock. And here we're talking about stock. So, but you can talk about a general approach for any securities. For any assets or securities, it is relevant to calculate the economic value or the fundamental value or intrinsic value of a specific asset. Anyway, so the idea here is I'm going to find the intrinsic value of the stock, and then I'm going to compare with the market value. And remember, the market value is not same as the intrinsic value. The market value is what is traded now in the market based on the ask and bid price. Let's go back to the first lesson regarding the ask and bid price. And what the buyer is actually offering, what the seller is asking for, and that's a market. However, the market value might be different than what you see as the intrinsic value. Now, if the intrinsic value, so let's look at this. If the market value is greater than intrinsic value, in this case, we'll say this stock is overvalued. That's the meaning of overvaluation. So this is the overvalued. So it sends you the signal that it is expensive or more expensive than it should be. So you go ahead and you sell it. So that's the result. You go ahead and you sell it. However, if the market value of a specific stock, for example, you're talking about Apple, you calculated the intrinsic value, and you notice that actually the intrinsic value of this stock is greater than what is kind of traded in the market. So that's a good signal for you to go ahead and buy Apple's stock. So that's the signal for you. In this case, we'll say that the stock is undervalued. There are several reasons that the intrinsic value may not be same as the market value. The first reason might be that the intrinsic value we calculated, maybe it's not accurate, because always we are considering several assumptions to simplify our calculation. But those assumptions bring us to some limitation. The second reason might be maybe there are some issues with the market price. Maybe the market is overreacting to a news, or there is some inefficiency in the market. We'll talk about the market inefficiency. We'll talk about some different approach to the stock pricing, such as behavioral finance. So we already talked about the intrinsic value, and I mentioned the intrinsic value indicates the true value or economic value. The notion or the concept behind the intrinsic value is that we are usually using the approach to find the intrinsic value by finding the present value of all future cash flows. So if you are able to estimate all the future cash flows and find the present value, you can find the value of the stock. So this is also called the fair price or the fair value for the stock. So for sure, there are several notes here. First of all, what is that cash flow? So in different approaches, we are using different numbers for the cash flow. One might consider the dividend payment. So we can consider dividend as the cash flow. Some people, maybe they go with the free cash flow, and based on that, they calculate the value of the company and then the value of the stock. And how we calculate the present value, we learned from our chapter 5 and actually module 5 that the present value is based on the discounting all this cash flow. So you need to discount back all the cash flows because we know as the time passes, the value of the money is going down. So you have to find the present value based on discounting all these future cash flows. However, we have some more approaches which are kind of more simplified versions, and comparable is one of those approaches which is much more simplified than finding the present value of all these future cash flows, which I'm going to talk about the comparables in this lesson. Before looking at a different approach for the stock valuation, you might ask yourself, what is the major incentive, or what are the reasons that some people or some investors are looking to buy stocks? So usually there are two major reasons, and for sure both are underlying this assumption that you want just to increase your money. So that's a major incentive to buy any type of securities. You want just to have more money. If you have, let's say, $100, you want to make it $200. That's a major incentive. But specifically for stocks, there are two major sources of cash, or there are two major sources of return. One is based on the dividend, and the other is based on the capital gain. So to explain this, let me show you an example. So I'm going to use the timeline as we had in module 5 for time value of money and for bonds. So here we are here. So this is time 0, the current time. This is one period, 1 year from now. Let's say that you are interested to buy shares of Apple. Let's assume the current price is $100. So if after 1 year the price goes up to, let's say, $110, and also you receive dividend by the end of year as, like, let's say $5, and this is per share information. So you receive $5 per share and you are buying just one share of Apple. In this case, you are getting some return. So one part of this return comes from your dividend. So you are getting $5 dividend. That's a part of the return you are getting. Usually when it comes to return, we prefer to express our return in terms of percentage. So how much you paid for it? $100. How much dividend you are getting? $5. So your dividend as a percentage of the price should be $5 divided by $100, which is 5% or 0.05. So your dividend yield, we call that dividend yield, or the dividend return in this case will be 5%. What about your other source of return? So what's happening here? The price is going up from 100 to 110. So the difference between the stock price is called capital gain. So your capital gain in this case is $10. So your capital gain is $10. And if you divide the capital gain $10 by the initial price, which was 100, you can find the capital gain yield. So in this case, your capital gain yield is 10%. So in a nutshell, you can write down the formula. The capital gain yield is P1 divided by P0 minus 1. So if you want to see how much gain in terms of percentage you had, you can divide the P1 by P0. It's showing how much the price is changing, again, in terms of percentage. So your capital gain yield is 10%, and your dividend yield is 5%. So if I ask you, what was your total return You can answer me and say, oh, 10% plus 5%. It was my total return. So 10 plus 5, it gives me 15% as my total return. And that's the whole argument for this stock investment. So you're expecting to get some return. Part of that return comes from the capital gain yield, as you see here, and part of that comes from the dividend. In some cases, there may not be kind of any dividend payment, so your dividend yield might be zero. Now, I several times talk about the capital gain, the price is going up, but there is a chance that there is a high chance that for some cases the price is going down. So in this case, if, for example, the price of Apple goes down from $100 to $90, you are losing $10. In other words, your capital gain won't be capital gain anymore. We call that capital loss. And so your capital loss in this case will be $10, and your capital loss, you can say the capital gain yield becomes minus 10% in this case. So you have to be clear and be careful that in some cases you might lose, you might end up losing your money. And this is the case when the price is going down. If it goes up, that's a capital gain yield. If it goes down, either you can say capital loss or you can say negative capital gain yield. So both are correct terms. So that's your total return. That's how we calculate the total return for a specific stock. If you're interested and you want just to have the whole formula, so let me use the R as my return. My total return should be my P1 plus D minus P no divided by P no. And based on this, you can calculate the return. You can rewrite this. So based on the argument we had, you can say, okay, that's a dividend divided by price plus P1 divided by P0 minus 1. So that's another way you can calculate the total return. So the first portion, as we call, that's a dividend yield. The second portion, it's showing your capital gains yield. So both together, they make up your total return, which is R. Now let's talk about the first approach for the valuation, which is using comparables. So one of the most common ways which you see many analysts are using is valuation by comparables. What you do in this case, you are choosing one specific ratio, such as price to earnings ratio or price to book value ratio, and how you can use these ratios to find the value of the company. That's the part I'm going to explain. So let's assume that the company has the EPS of $5. So earnings per share for company, so let's call this company A, is $5. You don't know what is the appropriate price for this stock of this company, but you can find a comparable. Either you can use, when I'm saying comparable, either you're using the industry average, or you can use another firm in the same industry, which is very similar to the company you are targeting to find the price for. So you find, let's say, the industry average, and you notice the price earnings ratio for the industry average is, let's say, 10. So the price to earnings ratio is 10. So that's a very comparable ratio you can use. And the EPS of company A is 5. So you can find the price of company A by multiplying the price earnings ratio of industry average by EPS of company A. So in this case, it becomes 10 times $5, and this gives you $50. This is one of the ways you can find, you can use comparables, and you can find the value or the stock value of the company. So it should be $50 for company A given the price earnings ratio. So you can use some other ratios such as price to book value, price to cash flow, and there are tons of ratios you can use to find the stock price. And my advice for you is just to use different ratios, and be careful when you are using ratios. Just make sure the company you are choosing or the industry you are using is relevant to the stock you are picking. Now, for some companies, especially for the IPOs, those companies who are going to the market for the very first time. They're just going to be listed in the stock market. You have to be cautious because since these companies are less reputable, the listed price might be a little bit less than what you can find from using comparables. So you have to discount for that newness factor, and then you can offer or suggest that price. Thank you very much. This is Ali Talabi. Next session, we'll talk about more approaches for valuation. So we are going to make it a bit more complicated and more realistic, and we are going to use different approach to find a stock price. Till that time, bye for now and have a wonderful day. Talk to you soon. Take care.